the S&P 500, STI, NASDAQ, Hang Seng Index, and FTSE 100. If you've ever tuned into financial news or read financial content, you may have come across these terms. In this episode, we discuss stock indexes or indices market and how we can trade and invest in them. To learn more about the indices market, we have OANDA Senior Market Analyst, Kelvin Wong. And we're also joined by Timothy Ho, co-founder and Managing Editor of DollarsAndSense. So instead of buying just one stock or asset, we can gain exposure to many with indices. So Tim, you're the go-to person when it comes to explaining these financial concepts. So how do you explain how stock indices work?
There's a lot of stocks in the stock market. In the US, I think there are thousands of stocks. So it's very difficult to see how well the stock market is performing. So we have this thing called indexes or indices. And these indices are basically a proxy of how well the entire market is doing.
Traders and investors will look at the S&P 500 as one of the popular US benchmark indices. And most importantly over here is that indices allows traders to actually gain exposure to only systematic risk, and they start to remove those very we call it firm-specific risks, which is diversifiable risk.
Okay, so as good as it sounds, we can't invest directly into indices. They're just a list, basically, right? We have to invest via financial products. So this can be ETFs or even CFDs, right? Contract for differences. So with OANDA, for example, you can trade major global CFDs, and with other stock brokerages, you can probably trade the listed securities. Right, so Tim, I'm going to rely on you again to explain some of these differences.
If you actually want to invest in the indices, you need an indirect way of investing in it. So a long-term, a popular way would be ETFs, right? So you have an ETF that may track a certain benchmark index. So for example, the ETF that tracks the S&P 500. What the ETF does is that it buys into the individual components of the stocks that represents the S&P 500. So of course there's CFD as well. CFD stands for contract for differences, where you look at and you are basically entering into a price position where if the price goes up or down, you make profits or loss depending on which side of the trade you are on.
Yeah. CFD is actually a derivative of the stock index. So contract as a particular, let's say for example, the S&P CFD, or in OANDA platform we call it US SPX 500.
Okay.
Actually, as a derivative, derived is price action on the S&P 500 futures.
So Kelvin, depending on how we gain exposure to the indices market, especially trading via CFDs, can you share some of the strategies that are employed?
Okay, so one of the first strategy we can do is having a directional view on the index. So let's say if a trader has a bullish view on the index within a short-term time frame, within a multi-week time frame, you could go long on that particular index.
Yeah.
Okay, let's say for example, you have a bullish view on the US economy because of a positive macro factor, lower interest rate environment going forward. You could actually look for exposure, a long exposure on any part of the particular benchmark US indices. Like OANDA, what we offer is the US SPX 500, and the other popular one is the US NAS 100, which is the NASDAQ 100 that comprising of the Magnificent 7 stocks, which everybody should be quite familiar with.
Yeah.
And the other one is the traditional, we call it the grandfather of the US benchmark index, which is the US Wall Street 30, which is actually linked to the Dow Jones Industrial Average.
Yeah. Okay, so when it comes to trading strategies, right? Besides taking long and short-term viewpoints, we can also use it as a hedge, right? So let's say, for example, an investor, they want to obviously invest for the long term, but being able to take the short position, also means they can hedge some of the short-term bearish outlooks.
Precisely. So let's say, for example, for a particular long-term investor, so one of the reasons for investing in a long-term portfolio of stocks, a basket of stocks, is very likely these stocks give that particular investor a very good dividend yield and constant dividend payout. But do not forget over here is that when it comes to a very persistent bear market, that means i.e. negative macro factors, almost all the stocks listed in the particular country stock index, stock exchange will likely fall according to this systematic risk. So during this, we call it a persistent major bearish trend, i.e. a fall of negative 20%.
Okay.
There could be a potential paper loss on this basket of stocks of negative 20%. However, for a particular long-term investor, he may not want to actually let go of this good blue chips, high quality stocks that give a consistent dividend payout. So to actually hedge this particular paper loss, this particular investor could actually look out for a benchmark stock indexes CFD that has a direct correlation or move in sync with his portfolio of blue chip stocks to take a short position. So in the end of the day, he will try to actually cancel out or negate this potential negative 20% of people loss.
There are so many indices out there, right? We've spoken about some of the popular ones already. But what are some of the characteristics that determines that this index is a popular one?
For a trader, right, to particularly choose a particular set of stock index CFD to trade, one got to look at the depth and the liquidity of the benchmark index. So for traders who are long in the market, most of the time we'll be looking at the US stock market. Why? Because it's the number one market in the entire world that offers a wide range of a high liquidity and as well as a depth of the market. So the thing about trading over here is that we need liquidity. Why? Because we are actually looking at volatility. So volatility allows traders to actually participate both ways, either in the bullish dynamic as well as the bearish dynamic. So one of the popular benchmark stock indices, CFD, that traders will tend to look out for in terms of that give us good depth and ample liquidity will be the major benchmark US indices, like the US SPX 500, the US NASDAQ 100, as well as the US Wall Street 30.
Okay. The other question I have is, if it's popular and if it's highly liquid, I would expect the spreads to be relatively competitive as well.
Yes. So when it comes to trading over here, as a short-term trader, number one, cost is also definitely one of a consideration. We also do not want to actually have, we call it elephant spreads between the bid and offer spread because we are taking into account a very short-term position. Instrument which has lack of depth and liquidity will actually find it very hard for traders to actually break even or even make a potential profit in a short-term period of time. So bear in mind, which is that in trading of stock indices CFDs, traders' time frame will tend to be much more short-term. We're talking about multi-day, multi-week, and even intraday as well.
Obviously, when we gain exposure into CFDs, there's going to be costs involved. The spreads are one way. What are some of the other costs involved in investing and also in trading?
Sure. So maybe let me touch about trading of the stock index CFD first. So we know that the spread is one of them. And we also do not forget of is that, like we discussed earlier, CFD is actually based on margin. So once you drop margin over here, because you just came up with an initial less than 100% of the initial contract value, so there will be like a financing cost as well. So daily financing cost, if for any open position, will be charged.
I think even for investing, your S&P 500 index might be very popular, but and there are a lot of ETFs that gives you that same exposure to the index. But you also want to consider the ETF liquidity as well. So if it's too small, you get a wider spread, right? And that is unnecessary, right? Because you obviously want a thinner spread. Of course, because you may not be trading in and out, it may not be that big of a deal. But if you are taking on a larger position, there might be some issues if there's not enough liquidity in the ETF. So that's obviously a cost for investors to consider. Assuming you don't use any margin financing in your investment position, then you won't incur that cost. But what you will incur is the AUM or the management fee cost, right? So like all funds, there will always be a management fee. It could be 0.5 to 1% per annum, and this will be a cost you incur every year as long as you hold the position. So that also kind of like in some way eats into the return. So as far as possible, you also want to minimize your management costs as well. And lastly, I think we're filming this in Singapore, so but we might be investing in the US market, right? And then there will be that forex conversion cost as well.
So what are some of the ways we can use to mitigate some of the risks that we get exposed to when trading? I'm sure there are some ways to have a stop loss function, a guaranteed stop loss. But is there any cost to it as well?
Oh yeah, sure. Because for guaranteed stop loss, there will be a cost to it. Because in OANDA trading platform, we do offer normal stop losses and guaranteed stop losses. So guaranteed stop losses, we actually guaranteed that particular level to execute for you. But once the level is being hit, there will be a small kind of a premium for the traders to actually pay on. But one of the reasons that we explain over here is why a robust risk management system is important, because trading stock into the CFDs, it comes with leverage. So as you know, that leverage is a double-edged sword. So it could actually magnify your losses as well as your return if things doesn't go accordingly as planned. So definitely having this, traders do need to take advantage of this available robust risk management processes or risk management tool that is offered by a CFD trading platform like OANDA.
All right, thank you, Kelvin and Timothy, for your insights on indices trading. When we trade indices, we don't have to worry about the risk of an individual firm getting delisted or performing exceptionally poorly. Instead, we are more concerned with the broad market performance and macroeconomic factors. that may have an impact on the aggregate corporate earnings and growth of a particular country or companies. Some of the reasons that we discussed, to trade indices or invest in indices is to gain both long and short exposure. We can use it to even hedge our existing positions in the market, right? And especially like Kelvin, you mentioned, we can also employ leverage to magnify our positions. As always, we need to consider the risk as well when doing so, right? Leverage is high risk and losses can exceed our deposits. We should also stay up to date with the relevant information, and we can do so on some of the CFD brokers like OANDA itself. So we can take advantage of demo accounts as well to test our trading strategies, and like you mentioned, when we're confident to go live, we should also use risk management tools that are provided by the CFD brokers, such as stop loss functions and guarantee stop loss functions. All right, thanks guys.
Thank you.